Imagine there's a stock you genuinely want to own. It's currently trading at $50 per share. But after researching the company and looking at the valuation, you decide you'd feel much better buying it at $45. Now, you could place a limit order at $45 and wait. Or you could use one of my favorite option strategies, selling a cash secured put. Now, in a nutshell, you can get paid upfront for agreeing to buy 100 shares of that company at $45 if you're assigned. Now, that sounds like a pretty amazing deal. You either keep the payment and nothing happens, or you could potentially buy a stock you already wanted at a lower price. By the end of this video, you'll understand exactly how this strategy works, how to calculate every important number, what assignment really means, what can happen before expiration, and how to decide whether a trade is actually worth doing. A cash secured put is an option strategy where you receive premium upfront in exchange for accepting the obligation to buy shares at a specific price while keeping enough cash available to complete that purchase. In normal language, I'm saying, I'm willing to buy this stock at my chosen price. The money is ready. Pay me for making that commitment. Everything else we're about to cover explains the details and the risk inside that agreement. Now, every option contract has two sides, a buyer and a seller. The buyer of a put pays for the right to sell shares at the strike price. Now, why would somebody want that right? One reason is protection. If they own ABC Company at $50 and buy a $45 put, they have the right to sell at $45, even if the market price falls much lower. The put seller is on the other side. You receive the buyer's payment, but you accept the obligation to buy those shares at $45 if the option is exercised and you're assigned. Now, the buyer has a right, but not the obligation. The seller receives premium because the seller takes on that obligation. That is the relationship I want you to remember. Let's build one train using a fictional company called ABC. Now, ABC Company trades at $50. You like the company, but you only want to buy it at $45. You sell one $45 put that expires in approximately 1 month, and the quoted premium is $1.50. Now, first, one standard option contract represents 100 shares. That means the $1.50 premium is quoted per share. So you receive $150 when the order fills. The $45 number is the strike price, the price at which you may be required to buy those shares. Now, when your order executes, two things happen. First, you receive the $150 premium. Second, your broker sets aside your buying power or cash to secure your obligation. For this trade, a fully cash secured put, the basic cash requirement is $45. For this trade, a fully cash secured put, the basic cash requirement is $4,500. So you keep $4,500 available to purchase the shares. That's the cash secured part. The $4,500 still belongs to you, but it is committed to be collateral for the trade until the trade is either closed out early, you are assigned to buy the shares, or the contract expires worthless. This is also where a cash secured put differs from relying on margin or borrowing power. In this lesson, I am assuming the full purchase amount is available in cash. I'm not depending on borrowed money, my next paycheck, or selling another investment to survive assignment. Now, something to remember is premium received is not the final profit. This distinction is super important. You receive $150 up front, but that does not mean you have already completed a profitable trade. The contract is still open and its market value will move. If the put later trades for 50 cents, you could potentially buy it back for $50 and close the obligation. You received $150 up front and paid $50 to close. The cash arrived on day one. The final profit or loss depends on how the position ends. A good mental rule is premium received is cash flow, but profit is the net result. If you hold this put through expiration and it expires worthless, the maximum profit from the put itself is the $150 premium. ABC could rise from $50 to $60 or $100, but my maximum profit on this contract remains $150. I don't own the stock, so I don't receive its unlimited upside. That's the trade-off. Now, let's calculate the break-even at expiration. If you're assigned, you technically pay $45 per share, but the $1.50 premium offsets part of that purchase, giving you a $43.50 effective purchase price across 100 shares. The break-even is $43.50 specifically at expiration. Before expiration, the option can still have time value, so the live profit or loss will not always match a simple stock price comparison. Now, what's the maximum theoretical loss? If ABC stock goes bankrupt and falls to zero and you're assigned, you pay $4,500 for worthless shares, offset by the $150 premium you receive. Maximum profit for the trade is $150. Maximum theoretical loss, $4,350. That imbalance is why company selection and position sizing matter so much. Now let's talk about intrinsic value, time value, and why this put is worth $1.50. An options premium can be separated into intrinsic value and time value. For a put, intrinsic value is the amount that the strike price is above the stock price. If ABC is at $42, a $45 put has $3 of intrinsic value because its holder has the right to sell for $45 when the current market price is only $42. But our put begins with ABC at $50 and the strike at $45. The put is out of the money and has zero intrinsic value. So why would anyone pay $1.50 for it? Because there is still time for ABC to fall before expiration. That possibility gives the option time value, or theta. Now, as expiration approaches, time value decays. If ABC stays at $50 and everything else remains equal, the $45 put becomes less valuable. That helps you as the option seller because you sold high and may be able to buy it back lower or just hold until the contract goes to zero. This effect is called time decay, or theta, and this is the main reason option sellers make most of their money. Now let's talk about implied volatility. Now this is where the market reflects its expectation of future movement embedded in option prices. When expected movement rises, option premiums generally become larger. That may look attractive when you're opening a trade, but it also signals more uncertainty and volatility. Earnings are a perfect example. Premium may be unusually high because the market expects a large move after the report. The larger premium is not a gift. You're being paid to accept a larger event risk. Now let's put the entire strategy together and look at 4 theoretical outcomes. ABC finishes at $48. The $45 put is out of the money because the stock is above the strike. It has no intrinsic value and would expire worthless. You keep the $150 premium, receive no shares, and the $4,500 securing the contract is released. Your return on the collateral for this specific trade is 3.33% for the trade. Outcome 2. ABC finishes at $44. The put is in the money by $1 because the $45 strike is $1 above the $44 stock price. Assignment would be expected at expiration. Remember, you were assigned 100 shares at $45, spending $4,500 on those shares. Now the shares are worth $4,400, creating a $100 loss relative to the strike purchase price. But you received $150 in premium, so you actually have an overall profit of $50. This is the surprising outcome. You were assigned, but the trade is still profitable at expiration because ABC is above the $43.50 break even. Now here's outcome 3, where ABC finishes at $42. The put is in the money by $3 and assignment would be expected. You buy 100 shares at $4,500 while the shares are worth $4,200. Your effective purchase price is $43.50 after premium, leaving you with an unrealized loss of $150. You can then hold the shares and wait until they appreciate, or you can then initiate the wheel strategy by selling a covered call on those shares, which we'll talk about in another video. Outcome 4, where ABC falls to $30 per share. The put is in the money by $15. You have to buy 100 shares at $45 even though the market price is $30, leaving you with $1,350 unrealized loss, which is why it is so important to choose a stock that you actually want to own. The $150 premium provided only $1.50 per share of protection. It did not protect you from a major decline. Even if this happens, though, there are ways to manage, such as dollar cost averaging, holding till the stock goes back up, or even rolling the trade. This is the big drawdown of selling cash secured puts, but if you selected the right company at the right price, it's really not that bad. Just think of it as the cost of doing business. Now, why do I love this strategy? I've made money driving Uber, teaching music, doing upholstery work, and taking on jobs where income is directly attached to my time. If I stop working those hours, that specific income stops. Cash secured puts are different. Once you've researched the company, selected the trade, and opened the position, you don't have to perform another hour of labor for every dollar of premium. Your capital is doing the work. That makes this one of the best forms of passive income that I've personally found. I also like how naturally the strategy fits into a moderately bullish investment plan. I'm not selling a put on a random ticker just because the premium is high. I'm potentially getting paid while waiting for a company I actually want to own to reach a price I find attractive. My bullishness on this strategy is conditional though. I love cash secured puts used on the right company at a defendable strike in a responsible position size. I do not love selling puts indiscriminately. Now here are the risks that actually matter. The largest risk is owning a falling stock. A company can look attractive at $45 and then fall to $30 because the business deteriorates, the valuation was wrong, or the market changes its expectations. The second risk is concentration. You might like ABC Company, but 100 shares could make it way too large a part of your portfolio. Now, liking a company does not make unlimited position size safe. Third is opportunity cost. The $4,500 securing your put is committed. If another opportunity appears, you may have to pass or pay to close this position. The fourth is liquidity risk. An options chain shows a bid and an ask. The bid is roughly what the buyers are offering. The ask is what the sellers are requesting. The midpoint is usually where your trade will execute. Now, a wide bid-ask spread can make entering and exiting more expensive, so I prefer contracts with healthier trading activity and tighter spreads. Now, here is my trade selection framework. I start with the company, not the options chain. Now, do I understand how the business makes money? Is it profitable? Is it moving credibly toward profitability? What does its cash flow, debt, and balance sheet look like? Does it have a competitive advantage? And what could permanently damage the business? These are all very important questions. Then I evaluate valuation. Now, I wouldn't mind owning it is not enough. At what price does the expected reward justify the risk? Would I still want it if the market price fell another 20% after assignment? Next comes the strike. The strike should represent a purchase price I can defend based on the company, not the premium I'm trying to force. Then there's expiration. How long will my cash be committed? Does earnings occur before expiration? Is there a regulatory decision like an FOMC meeting? Is there a court case, a product announcement, or another event that could create a major move? These are also very important questions. Then there's premium. I convert the quote into dollars, calculate the effective purchase price, and compare the payment with the capital, time, and risk involved. Finally, I size the trade as though every contract will be assigned. At a $45 strike, 5 contracts creates $22,500 obligation. Now, if that would make ABC too large in my portfolio, 5 contracts are too many, regardless of how attractive the premium looks. Here are some common beginner mistakes. The first mistake is chasing the largest premium possible. My order is company first, strike second, premium third. The second mistake is oversizing. One contract means a possible 100 share position, and every contract can be assigned. The third mistake is ignoring events, liquidity, and the cost to closing. Now, before I sell a cash secured put, I might ask myself, do I understand the company and its major risks? Would I buy 100 shares at this strike today? What is my effective purchase price after premium? Would assignment make that position too concentrated in my portfolio? Now, what happens if the stock falls another 20% or 30%? Are earnings or other major events before expiration? Is the bid-ask spread reasonable? Is the premium worth the capital, time, and downside risk? Do I know whether I plan to close early or accept assignment? Have I checked my broker's expiration and assignment procedures? If I can't answer those questions, I'm not ready to place the trade. Sometimes the correct decision is a lower strike, sometimes it's a smaller position, and sometimes it's no trade at all. Now, the final takeaway is this. A cash secured put pays you premium for accepting an obligation to buy shares at a chosen strike while keeping the purchase cash available. It can generate income that is not directly attached to another hour of your time, and it can pay you while you wait for a stock you want to own to reach a price you like. The company matters more than the premium. Position size matters more than the premium, and your ability to survive an unfavorable outcome matters more than the premium. That is the mental model. Get paid for accepting a purchase you already want, but analyze the obligation as seriously as if the shares were being assigned today. If this video helped you finally understand cash secured puts, consider liking the video and subscribing. I'm going to continue breaking down option strategies with real examples and showing you exactly how I think through these trades in my own portfolio. Thank you for watching, and I'll see you in the next video.